so you can see me, and then you can also see you. 1 second, let me crop your photo. Shift 4.
Are you making a thumbnail or are you adjusting my video
No,
classification?
I'm just adjusting your video, this thing, so that I want to capture another video capture, and I want to put you on the top right. Video
Cool,
cap,
cool.
video capture device, window capture. Okay, I want to just capture your face. This is on Google Meet, right? This is on Google Chrome. This is Meet. Yes, this one. And what I'll do is
Mhm.
I'll make this very short so that this comes to the left of me. Then I'll crop it a little bit more. And I'll actually bring it here on the left side. So I'll be on the right side, you'll be on the left side. And I'll add your name in the bottom. I'll add a text, and I'll put your name, Prashant, and add it just below your name. I have to make it black font. This is completely white.
Yeah.
Black font, okay. And bottom is also black. There is no gradient. It's completely black. Okay.
Is this a software that you made or is it something that you?
This is OBS, but on
Okay.
OBS, I have made a software that I'll show you,
Hmm.
right? And but see if we are visible there on the stream. Are we there? Are you
I'll
there?
just see the latency.
Uh,
Yeah, I think my Excel sheet is here. Can you just wave your hand? I'll see just how the latency is.
it's very low. It's ultra low latency. I've selected the latency to be ultra low on YouTube, but YouTube will always add its own 5 second
Yeah,
delay,
yeah, 5 seconds.
delay
Yes.
for its own stuff. So they do some kind of a ML stuff.
Okay, are we good to go? Can I share the link?
1 second, I just want to
Sure, sure.
add your camera better because your camera is coming completely cropped. Let me remove this one. Yes, and then I will add a fresh camera. Where is Gmeet? Gmeet is here. This is Gmeet. And okay, hey, it's gone. Okay, it's green color. Okay, then I do this media source. Okay, why is your Gmeet not coming as a media source? 1 second, 1 second. I
Mhm.
have a solution. I have a brilliant solution. I will pin your video. So you, but just be aware that whatever you do, it will be completely pinned for the whole this thing. And
Mhm.
1 second, adjust view, and then spotlight, and then yeah, and then you are the spotlight. And then I'll make you small, bottom left. Yes, now it's a hacky work, but it still shows only you on the bottom left side. I'll hide my tile. I will minimize this. Okay,
Mhm.
but you are visible at the bottom left. And
Cool.
what I will do is I'll move my sheets to the left so that you will always stay on top. Now it's, yeah, and we'll put this in the top. You're always
Mhm.
on the top. Okay, done. We are good to go. So
Perfect.
we are good to go, my dear friends. Let's go.
Yeah, I'll go ahead and share it.
Yes, please feel free. Uh, I hope our audio is coming through okay for everyone, right?
1 second. Let me check that as well.
Hmm. and just I'll put that in the chat that we won't be
Once again.
monitoring the chat. We won't be monitoring the chat during the class, so we will answer the class after this. We won't be monitoring the chat.
Perfect. The
We
audio is
will answer post the session. The session is expected to run for 1 hour till 1:10, 1:10 or 1:15, 1:10 p.m. IST. I'm putting this here. Okay. Done. So you can now share. So what I've done here is I've seen your analysis here. This is for, and I'll start the replay buffer also so that people can get some amount of this thing, right? So, and the chat is here. Actually, I can answer chat as well. Anyway, so you can see my sheet, right? My sheet is visible, not visible.
No, not visible on Google Meet.
Okay, so what is visible on Google Meet?
Just your video and mine. The sheet is not visible.
Okay, so do one thing. Don't look at this thing. Look at the live stream. Just leave the Google Meet, minimize the Google Meet, look at the live stream.
1 second. I'll see if.
Because you can see the sheet there.
I'm trying to unpin both of our videos from my screen.
I have pinned it so that you are visible to all. Otherwise, you won't be visible.
Achha. Okay.
I want you to be continuously visible, and I am at the bottom layer. So I have added my local camera, so it's always on. Your remote camera, for some reason, is not giving me permission to be on. That's the reason I'm just putting Chrome tab at the bottom left with your face as the focus, so that you are always in the focus. And then what I'm doing is I'm putting this thing. I'm putting the sheet in the front.
Okay. Yeah, I think the sheet is visible in the live stream.
So you joined from the live stream, no? You look at the live stream.
Yeah, I'm on live.
Yeah, just minimize this thing and look at minimize the Google Meet and just keep looking at the live stream. I'll zoom the sheet up a bit.
Yes.
So this is for Apollo tires.
Yeah, this is for Apollo tires.
Okay.
So the first sheet is what you've asked me to cover. This EBITDA margin, net debt, PAT, CFO comparison. The second and third sheet onwards, I've tried a little bit of benchmarking with other tire companies.
Okay. In million rupees, that means by 10 in CR. So either to convert that into a dollar or convert that into CR.
Okay.
So if you are doing it million, it's perfectly fine. Then make it $1 million. Divide by 100, so it becomes $1 million.
Right.
Approximately. So then, USD just. So it's a $2 billion company in revenue. Around $2 billion company, and then we don't want so much. Approximate is fine. So let's keep this one as revenue. Command C, Command V, and then let's hide this row. Okay, EBITDA is so much. Again, EBITDA in insert one row below. Here, insert one row above. Command C, Command V, Command C, Command V, Command C. Okay, and let's hide this one. Hide this row. EBITDA margin. Okay, this anyway would be in percentage, so let's keep it 12%. Okay, 12%, 18%. Fine. Net debt. Okay, 24. So this is again in insert one row below, insert one row above. Okay, so this is how much? This by 100. So this is 246 million USD. Okay, this is so two net debt means this is for two separate years.
Sorry.
So you have put two net debt here, 24644 and 24800.
So 24644 is the calculated figure. But then there's a separate mention of net debt as well, wherein they mentioned it's 24.8. I think 24.8 billion. I think. Let me confirm what it is.
So they would have taken so short-term debt, long-term debt, and current portion of short-term debt, current portion of long-term debt. That is what they would have taken. Let's take a look. Net debt.
Yes, 4.8 billion. But there's no measure as to how they were right. So my measure was there was a specific ratio net debt by EBITDA. I calculated EBITDA from consolidated. I multiplied it by that ratio, and I just got net debt, which is 24.6 something billion.
Okay. And then this is profit after taxes. Insert one below. Insert one row above. This is this by 100, 63 million. On a 2 billion revenue, we have 63 million profit after tax. Approximately 2 billion, yeah.
Yep.
We'll look at the benchmarking as well. Because I did, so what I've done earlier in my, I've analyzed Bridgestone. So Bridgestone also makes tires, and what Bridgestone faced trouble in was increasing cost of natural rubber. So natural rubber usually comes from Southeast Asian nations, and it requires a lot of, so Kerala anyway, Kerala and wherever there is a lot of rains and appropriate condition, then there are those are Indonesia, I guess, Malaysia. Malaysia is known for rubber and stuff. So
yeah, Borneo.
Yeah, Borneo, the entire archipelago of Indonesia. So Java, Sumatra, Bali, Borneo, that entire region, and Malaysia. So the point is, as natural rubber goes down, the synthetic rubber is not as durable, and most of these heavy duty vehicles they require natural rubber. So the cost of raw material is something that might impact their profitability. Have you calculated what is this percentage of this 12% is EBITDA margin, right? The PAT after as a percentage of revenue?
PAT as a percentage of revenue is there in the next sheet.
Next sheet, acha. Okay.
Profitability sheet, third sheet, sorry.
Okay, because the ratios is where we have, yes. Okay, so the revenue is fine, absolute numbers are fine, margin. So yeah, so entire industry is around 10%. There are some outliers. Apollo Tires is one. It could be product differentiation for them, due to which they are able to sell different kind of tires and whatnot. EBIT margin is again 10% approximately. Is there a seasonal impact? No. Very less. Around 50% goes up. Apollo Tires has the maximum volatility. If you select this, just do simple var of these three and you will see. Right? So, and then whatever you can color code it and no, not sheet. We didn't need a sheet. Needed chart. Insert. Where is the chart? Yeah, here. Working. Yeah. So it shows as MRF has the highest variability.
Mm-hmm.
This is for data of 4 years. MRF is the second one, right?
Yes, the second one is MRF.
Yeah, it's
and this is
almost
over a
double.
period of 3 years.
Yeah. So if you put this variability as a percentage, approximately, yeah, MRF Apollo Tires has.
I think it is 4 years because the first percentage is taking into account the previous year as well. So,
So that means it's kind of stable analysis that MRF suffers a lot of vulnerability, and Apollo Tires is sponsoring Indian team, right?
MRF is doing a lot of motorsports.
No, Apollo team sponsored Indian cricket team, right?
This I'm not aware.
See, this came in the news. Let's go to all. Yeah, see, Apollo Tires announced as lead sponsor of Team India. I know because this came pretty recently. See, this is the BCCI's announcement. This is pretty recent. See, 16 September 2025. Right? It's hardly 5 months old. So till then, someone else was there. So Apollo Tires is the sponsor of Team India. Why am I mentioning this? I'm mentioning this because there's a very popular myth that goes that whichever team sponsors. You're aware of that popular myth.
Yeah, Sahara, Byju's.
Yeah.
Dreamland.
Yeah, so I kind of thought that maybe that is at the back of your mind when selecting Apollo Tires. But anyways, so again, there is no mathematics behind that, so we'll not use that as an example. But the point is, if suppose you live where you live and the friends come to play cricket on Wednesday, then you'll only score centuries on a Wednesday. It's not that Wednesdays are more auspicious. It's because everyone plays on Wednesday. If everyone played on Thursday, then you could score a century on Thursday also. Right? So if everyone believes something and the investors are not rational, then the stock will crash.
Certainly.
Right? So that's the behavioral finance and those things coming behind it. But let's come back here. So this is Apollo Tires. So technically, what we have busted the myth is that at least the margin is not as volatile as it looks. Right? This is the sheet. This is the data. EBITDA margin. What about the EBIT margin?
EBIT margin is right below EBITDA margin. Essentially.
So these are the three ones. You also see again Apollo kind of going way ahead. So this is, I think, the second one for 3 years, and if we just try to let's do a custom one. Standard doesn't make individual make sense. And use column DS, no, column DS labels. So these are the four ones, right? So then you have 4 data points. You see that center one was the year. So this year we saw the biggest 2024. We saw the biggest jump, and revenues. That means 2023 was the year of slump. 2024 saw a bigger jump. You see like a mobile signal. Just so when everyone benefited, so when Apollo benefited 50% jump, MRF saw 100% jump from 6% to 13%, 4% to 9%. Everyone just doubled their um, margins.
Yes.
They were able to only do 50%, and then they came back to this point. So when they fell, this shows that this is the steady state kind of thing. For others, they have still not returned to steady state. MRF, CAD, JK, they went up. There was a market fluctuation, demand, the industrial activity picked up. So, like ton of things can come here. So, the India Gati Shakti program, the industrial corridor, the India's growth in logistics sector, India's dependence on trucks for moving the items. India still doesn't have a strong railway network for. India does have a dedicated freight corridor for evacuating finished goods from factories to the ports, whether it's Vishakhapatnam in the eastern coast or Paradeep in Odisha. We have some ports in Kolkata, but a lot of evacuation still happens through trucks, and highways are the very faster ways to evacuate. So there are inland container depots as well, ICDs, from which the evacuation happens. So if a lot of fleet gets added, then the tires get sold, because so a good analysis of this could be a good breakdown for this could be, if you can if you're analyzing this company just from the impact on the EBIT margin, see what percentage of their sale came from institutional sales versus retail sales. So like folks like you and me buying for scooter and car, or folks like fleet owners buying, that's one. Second is so just like if you buy a bike, you will, for example, when I bought my Honda City, the tires that came, and I went to Team BHP. It's a very popular car website. Everyone who is a member there who posts about Honda City and purchasing Honda City, they say that the moment they buy, they check the tires, they install a fresh tire. It's because to keep the cost low, they have not skimmed on things which cannot be skimmed on. For example, if you have a laptop, you cannot, and the motherboard cannot be changed, your CPU cannot be changed, your GPU cannot be changed. So if Lenovo is kind-hearted, Lenovo wants to give the best deal to Prashant. What Lenovo will do, they'll give very less RAM, because RAM can be upgraded, hard disk can be upgraded, but CPU and motherboard cannot be upgraded. So they'll give you fastest CPU and motherboard, but lower RAM. In the same way, if I am your well-wisher, I want to. Which bike do you own?
I have an Avenus, Suzuki Avenus.
So if you have a Suzuki Avenus, for example, and I have a Suzuki Access 125, or someone has a Suzuki Katana, Suzuki wants to give the best price, but they are not able to sell a bike for more than, for scooty which I purchased was like 1 lakh rupees, 90,000 rupees. On road it was like 1 lakh rupees. Suzuki Access 125. They know that people will not buy 1.1 lakh rupees Suzuki Access. So what they will do is they will just install a cheaper OEM tire, and those tires, they have like a bulk deal. India sells 10,000 Suzukis, all will have Apollo. That's a second source of revenue for these. So they have a institutional tire. So that's the third way of looking at margins. So once is folks like me and you, retail buyers, going to a shop and buying. Then second is fleet owners, like the truck owners and those buying. Third is direct sales to auto OEMs like Suzuki, Honda, Hero. Honda is close to Hero, TVS. So they would have contracts that all TVS scooters will have only MRF, for example, unless TVS starts making its own tires or whatever, right? So did that change? So did the big jump come from a lot of trucks being purchased because of India's policy of scrapping old vehicles, or scrapping, needing different kind of trucks, whatever, I don't know, right? So that could explain this. That's how. So when you analyze any company, you need to know its what it stands for, its fundamentals, and then you start to see. Then this chart makes more sense. And why did everyone jump?
And can you please check out column B? I've added a photo right now.
Column B. You have added a photo in column B.
P.
P.
Yes.
Okay. Ha. See, passenger vehicle, light truck, truck and bus, off highway. So revenue segmentation by customers. So replacement is still 80% and OEM. So this OEM is what Suzuki and stuff. 80 is that replacement. Then we have revenue segmentation by products. So you have passenger vehicle and 38%, truck and bus, light trucks. So I think Apollo tires is not there in scooters. It's only there in cars and tempo travelers and then buses. And so yeah, buses I also missed. Governments are launching a lot of electric buses. Buses will still require tires, whether it's electric or internal combustion buses. They will not put the tires of older bus into a newer bus, for example. This one, and off highway is looks like this light purple segment, which is 8.9%. That's This is a good segmentation. So then jump on this year on year. Like has this composition changed year on year, right? So this is something that will help us understand why there was a big jump this year. What were the causative factors of this jump? Policies or someone spending once, and then that spending comes down. And if you use websites which aggregate data across multiple years, so extension of this could be if you plot across 5 years. So do you see this as a sine curve? Is it a cyclical pattern that people buy something for every 5 years they replace it? So every 5 years you see a jump. So you will see the seasonality coming into this picture here very quickly the moment you are able to look into this part. So uh, let's financial statement mastery. So we have downloaded the annual report. We are now identifying revenue, EBITDA, PAT, CFO, and net debt. We'll do the recasting as well, operating versus non-operating. So operating part, of course, comes from all the core business operations. So you would have money coming in from, where is the cash flow statement? PAT. Revenue. This operating margin. Okay. Okay, so you have mentioned raw material cost inflation here. 11% increase in raw material cost year on year, I assume. And then revenue from operation growing and net profit stays around 11 by 25%. 5% of the revenue is the net profit. So it's like an airline business model. There is barely any profit. So in a revenue of, for example, take FY22, on a revenue of 210 billion rupees, they made a profit of 6 billion rupees. So it's around 3%, 3 to 4%. So they are barely making any. If you just see from revenue from operation in the net profit, it's 3 to 4%. It's barely aircraft model. And here you would see, I don't know why this JK has a minus 2.06 here. It kind of shows that the market has slowed down for them, but it has accelerated for CATC, 5.56 to around 11%, almost doubled here. Everyone has seen, but Apollo and JK, so this could be an answer that their segment, these are segments where they're operating. So if I go to profitability and the segment that you showed, passenger vehicle, light truck, are these segments slowing down? And is this replacement, the mean time to replace, going up? That means if people are keeping the older tire longer instead of replacing it, right? This is something, has this slowed down? This is something that is, or are these segments seeing slowdown? For example, car sales went down and then GST reforms were announced so that the car sales could pick up. The entire Indian consumption was slowing down, and the first measure of slowing consumption is fall in use of or procurement of consumer vehicles, passenger vehicles, and such goods. So this, if you see, 38% is passenger vehicle, which is B2C segment, and then around 40% we can say it in that way. So that impacts Indian GDP's growth, directly impacts Apollo Tires growth percentage here. So if you see here, the growth percentage stays around 3%, 3%. and this 12-17% would be a recovery post-pandemic for Apollo tires. That is the reason this is a high number. And the moment they reached around 25,000, I don't know what the unit here is, but I think it's in million rupees that you have mentioned. This growth is coming down to 3%. This is something that you would find almost. Third is we have not seen the market composition. This is if you do a study of the entire Indian tire market. So are these four an oligopoly, not oligopoly, are these four doing a monopolistic competition? That means because their market caps are, they're not market caps, their revenue is quite similar, 26, 28, and then these two. These two are like equals CAT and JK and MRF and Apollo. I don't see a Bridgestone here. I don't see any of the smaller players here, which shows that
India is there, TVS Sri Chakra is there, but they all operate in. So the revenues are very tiny. If revenues of these people are in the $23,000, $24,000 range, theirs is probably around 2,000, 1,000. So that's the segment they're playing in.
So that means that these four are literally 90% of the Indian tire market. 80 to 90% of Indian tire market. If others are like tiny, 2,000 crores, so and then it will be like 4,000 crores. So if you add this, simple mathematics, if you add this plus this plus this plus this is the total. Plus you add suppose 4,000 whatever for them is. So then this is the entire Indian tire market, right? This is the entire Indian tire market. So then we can do some kind of a analysis. If you put this by this, so this is around 30%. So approximately we can say 30% of Indian tire market is Apollo tires.
Yes.
And then we can do the same thing here. Of course, I should have put an F4. 30%, yeah. So 30 to 60, and then this would be around 15%. What is this by this? Yeah, so we can see this around 30. So it's 90% is all these. So 90% by four players. This kind of shows that the market is fairly dominated by two players. 65% by MRF and Apollo. So if the largest player is growing at 11% and the second largest player or just same player is growing at 3%, then you would have to see why there is a difference between Apollo and MRF. This goes to a comparative statement. Apollo versus MRF. So why does Apollo and MRF both having the same Indian market, same customer segment? I don't know if you have the MRF equivalent of this thing. Revenue segmentation. Can you hunt for this? MRF's revenue segmentation by product. If you have another tab open, because my all screen is occupied by this.
Sure. Searching for it right now. I'm not very sure if there's a diagram available because I didn't see
any approximate numbers will also do.
Yeah.
Let me try here. Let me also open MRF. This is okay. Revenue segmentation by products. Revenue. Revenue segmentation by products. So yeah, it's even this thing gives. So truck 44, passenger 14, two-wheeler 15, and other paints, toys, tubes, conveyor belts, and these. So replacement is again 70 and OEM is 20. So if I come back here and I put it here, so the profitability. This is paste values only, right? So truck and bus, here is passenger vehicle is 38. So see, that's a bigger difference here. So here passenger vehicle is 38.4 for Apollo. But for MRF, that's not the case. it's only 11%. For them, the biggest revenue is truck and bus tires. Actually, this is matching them. This is also 41. So it's actually even Stevens. But the passenger car and tires, they have 11%. This is 38.4. They are there in two-wheeler and three-wheeler. Apollo isn't. And then you have light commercial vehicles. So then you have 8.9, and then everything else around 11.4%, whatever. Right? So this is, see, here 10%, 9%, 10% almost same, Apollo MRF. 11%, 11% approximately same. The only difference comes here. Passenger car tires here. And that could be the reason. So if you see Apollo 38% on passenger car tires, and now with this information, actually I should copy this and I should put it here. Revenue, scale and growth. Yes. So with this, now you can see here. And I'll only highlight this portion and this portion. Oh, it's too dark. Yeah. So if you see these two, someone which has 38%, around 40% car domination, they have 3% growth. Right? Someone who has 10% car domination in the car segment dominating their revenue, they have 11% growth. Why? So because the weight of each, so the total weight will be 0.41 into the revenue coming in from the truck and bus, 0.38 into the revenue coming in from there. So because that means this segment has grown slower. This thing is even Steven. See, this doesn't matter. Both of them are 41%. So this is good for us. This doesn't make a difference. This is the biggest difference. That means being in car segment is bad if the car doesn't sell. So now with the GST reforms coming in Diwali and November, we saw a lot of cars being stolen just because the finance minister brought in GST reforms and cars became cheaper. So then who will be the biggest beneficiary between four of them? One who has the biggest share. Yeah, but when these players have a long-term brand partnership with Nissan, Toyota, not Nissan, Nissan is smaller there, Citroen, Toyota, Tata Motors, Maruti. So if you are analyzing them and their profile, your first research should be go and see whether Apollo would have, for example, if you see this one, say let's see Apollo partnership with Maruti. Let us see if Apollo has something. See this one. So they usually bring this OE fitted new age Maruti Suzuki Baleno. Is my screen visible? You will be able to see it on live stream, not on this thing.
Yes. Waiting for the screen to be visible.
I said because live stream has a lag. Understood.
Yeah.
Understood. So I can see it shows original equipment fitted to Baleno. It has 2022 this thing. It has a news article which says that there is a new age tires fitted to Baleno here.
Right, now it's just yeah.
Right. So what you can do currently is that you can go on Google Meet and pin my video stream as for you and minimize your tile. So you can also see me on Gmeet as well. You can also see this.
I can see you and my tile is minimized. Just that I'm not able to see your screen. That's the issue.
On Gmeet it should be okay, yeah, because I'm not sharing it through Gmeet. So let me try to do that as well. Let me try to do complete, but then in that case you will see. Okay, but you will have to then pin your window somewhere. Okay, and what I'll do is I will show my screen. I will minimize. I'll adjust the view. I'll put everything um, inside var, and here I will pin show the full video, right? And then I will hide my screen, adjust view. Okay, but then it will have a present something else. Then I will only show my screen.
Would you have to show the entire screen? I think.
No, I have only shared my this thing. I have only shared my.
Yes. Perfect. Now I can see things.
This works, huh?
Yeah.
Okay. So, but I don't know if your live stream still has your video coming in there.
No, but that's okay. I don't really mind.
Okay. It has a part of your video. Okay. So, in the bottom left there is your this thing, but I do not want this style to. Yeah, it is visible. Right. So, okay. But you can see this screen, right? Correctly?
Yes, I can see the main screen.
Okay. So, can you see this green part? This 41% both sides. So, this, because the 41% is same for Apollo and MRF. If I go back to the probability screen, and because that's where I pasted the entire entire breakup of Apollo and MRF and all the 4 portions here. You will see that Apollo and MRF have the same, almost same truck and tire business, 41%. The passenger car business is different here. I haven't looked at the business of of what are the other two ones are there, Seat and JK. So, but I assume that since their numbers are so small, they will not be the biggest gainers right now. So if you see on the revenue scale and growth tab, the slowest growth happened in 2024-2025, right? And this would have prompted the GST reform that the cars are not selling, and then but the two-wheelers are selling, so MRF and Seat and others are still making some. But Apollo is a good proxy for JK. So if you see these two, so next year we can predict, or by March we can predict that a big jump will come in Apollo tires and a big jump will come in JK. Because the passenger car sales would have gone up if and only if they have this kind of a agreement, like Apollo with Maruti Suzuki, right? Or let me see if Apollo has something with Toyota. Apollo partnership with OEMs. Let us see which OEM they have partnership. And that partnership should be for like OEM in India. Maruti Suzuki, and then we have Mahindra and Mahindra, we have Hyundai Motors. So when these will grow, they will grow. Mahindra and Mahindra. Right? Make sense?
Yes.
Right? So this is one such way of looking at or understanding why the reason behind these faults. Next is we have to recast this into operating and non-operating. Right? So that's the favorite part. So for this, let's open the Apollo Tires annual report. Okay. So you would have opened this one, right? FY 2025 AGM notice and annual report.
Yes.
Okay. 335 page 1, correct?
Yes. It's the same.
Now we have the fun part coming in. Where is the balance sheet?
Which page? Page number 270? Or rather,
it would be before somewhere, because we have the analysis on page 75. So it will be somewhere. Uh, so usually it starts with MD&A, management discussion and analysis, and then it's here. It's page 70 approximately, 71, 72 somewhere. Let me download it and then present it. It will be easier because Chrome is really slow.
Detailed balance sheet is also there in page number 192.
192?
Yeah, okay. This is standalone.
Okay, yeah, this is the one. So, what do we have here? Non-current assets, not much change here. Biggest jump. Look at the investments, B7. Trade receivables have gone up. An investment of 4934 has been made. Can you add 4934 with 18,594? How much is that?
Just a second.
Is it around 22k? Are they saying their investment is now receivable?
It's around 23k.
So what I am saying is, they would have given that money to someone, and then the person wouldn't have returned back, and then they would have written that as an investment. Is that the case? I'm looking at, so 18594 4934, 23,000 approximately. Because there is no change in trade receivables. Here it's 494139, so it is almost same. 1000 crore up and down, it's fine. There's a big jump here. And what is this? This is B10. B10 is other financial assets. Can you see this one? 4487?
Yes.
And then that's the reason for 7,000 crore, 700 crore rupees increase here, between here and here. So here, so let's go to B10. Let's see what has, and we also, let's look at the equity side as well. There's no change here. Liability, they have reduced their borrowings. They have paid back around 600 crore rupees. Lease liability is the same. Their deferred tax liability has increased. That means they have not paid tax for some portion of the tax for this year. The other non-current liabilities have come down. Their borrowings have increased, which is the short-term borrowings. This is the current liability. This is the current portion of short-term, long-term debt. You have to add this part here. From 7,000 to 10,000, there is around 300 crore borrowings. This is something that you will have to take a look at.
Okay.
B16. So B10 and B16. Then you have total outstanding dues of creditors other than MSME. See that this jump around 200 crore. This is B. So B10, B16, B17.
B16, B17. Okay.
B10, B16, B17. Okay. Profit and loss. So you have captured 11% jump in the raw materials. Here, if the quantity is same, then the cost of material has jumped by what? 1600 crores. It is 16% jump. It's not 11% jump. So look at B24 also. Due to this, the profit has literally halved. It was 20,000 crore. It was 2,000 crore last year. It became 100,011 crores. I don't know why it's in million. Okay. So 1,000 crore this year. So 900 crore fall is attributable to increase in cost of materials consumed.
Okay.
And current tax same, current profit of the year, and that is the reason you would have seen total tax expense. Look at the one is look at line number 7, which has
Mm-hmm.
profit before tax. It has literally halved from
Yeah.
1860. So that means 900 crores is the fall. It's attributable to this part, the cost of raw materials. Next is there's something very peculiar here. So if you see 11,000 whatever units million to 18, and this one 9 by 7. If you calculate 9 by 7 for both the years,
Mm-hmm.
so there is the difference. So for this 6294 divided by 96.03, 65.5. So 35% is the net tax rate of effective tax rate.
Mm-hmm.
And this is for the purple one. This is the current year. What I've done is 6294 by 9603. Let's do this into 18366. Now here our tax rate has gone up. 11540 divided by 183.66, 62. So their deferred tax liability is again hurting their deferred tax liability is it's increasing their current cash in hand, the profitability current, but it will be visible here. If you go up, you would see the increase in deferred tax somewhere.
Liabilities.
See this. This has jumped. C11. C11 has jumped from 1454 crores to 1613 crores. That deferred tax liability is huge. Just for a sense of the number, the entire deferred tax liability is same as their 1 year's income. So they are making around, no, it's not same. It's 10% of their 1 year's income.
Mm.
So that means and it's growing. So they, we have to see if this deferred tax liability is because of some um, MOUs that they have signed with government, due to which they get those benefits to be paid later, or this is just because um, they are not paying it. I don't know. So
Okay.
we'll not look at the legal side here, but we'll just look at it from the financial side. Let's go to the uh, our best friend, cash flow. Profit before taxes, depreciation and amortization is fine. No, operating profit before working capital changes. Again, here is a big jump here, and the difference comes from where? See, assets written off consequent to the closure of business. It's one time cash flow. Very small number, but still, it's one-time cash flow. Uh,
I'm not very sure. So if the asset gets written off because I'm closing a line of business or an entire subsidiary company, how is that an actual cash transaction? I thought it was an accounting expense or an accounting write-off.
they would have sold it at garbage throwaway junk sale.
Okay, okay,
I'm
okay.
thinking that it's like you're writing off that of your old scooter. You sell it for 5,000 rupees. You will get 5,000 rupees. It's very small, so its main price will be very high. They would have sold in some junk sale, or I don't know. This has to be looked at in some news article, that which assets they have sold off and which businesses they have closed. But what I'm looking at is that any one-time major portion here, major activity here. So this jump from 18 to 9 has to come from somewhere inside, right? So what is that big? difference between this and this. So this 18 is sum of all this. This 9 is sum of all this.
Yes.
Right? So there has to be one such large change. See the inventories. Can you imagine?
Yeah, that's almost what, more than 10 times increase.
So who can carry such huge inventory? The warehouses would be full. The receivables are very high.
Very high objectively or
Comparatively. See the trade receivables here. So if you run a shop and I run I run a just like we have the borrowing account in small kirana shops that hey Naval can buy things, you can add and register. One he'll come every month, he'll clear his whatever. That is receivables, right? So your shop has receivables. You have sold so many things and there are so many people who will come and pay you. The trade receivables in the normal lending practices will not go this big.
True.
It will go this big when you either have people who you have sold materials to, they don't have money to pay you, or they say that sir, I'll take things from you, but if they don't sell, you take it back. Then I will extend a line of credit to you. So then also you will have trade receivables because inventory and trade receivables both have gone up. That means I'm not able to fire people. My factory is still producing tires. Tires are not getting sold. So and the dealers are selling. Sir are saying that sir the market is not buying. What do I do? So if you have a small shop, right, and I come and dump my things, you'll come and say, hey, Naval, your items are not selling. If I keep the shelf empty, I can stock some other things and sell it.
Absolutely, right? Yeah.
So I'll say no. You keep it. You say, Naval, I'm not going to pay you because it's not selling. I'll not have my cash blocked. I say, okay, don't pay me anything. I will even open a store. I'll open a warehouse in your city. Dump everything in the warehouse. When someone comes, go and ask a boy to go from the warehouse and bring it and sell. That is like full increasing this part. So we don't know whether inventories are lying. Is this inventory? So if they would have extended their trade receivables to OEMs, because you have mentioned that they have around what? Let's go back here. They have around 38% passenger car tires. That means they would have showrooms. So if you go to all showrooms, they would have given tires. They would have be Apollo tire corner in every showroom. So that means have they given advances to them, or have they given advances to buses and trucks? Are the bus owners and truck owners not paying? Who is taking material and not paying? So if you see this large purple thing, this is passenger vehicle, and then you have truck and bus and light truck. So if you add just passenger vehicle and truck and bus, that is around 80%. 80% of the revenue is a passenger vehicle and truck. That means truck is by Mahindra and Tata. So the good point for you is to look whether Apollo has any tie-up with Tata for both the trucks and Tata for the cars. And if the cars are not selling, then both of them, the inventories are stuck. Make sense?
Yes. Yeah.
So next is, see this one, trade payables. This is decrease in operating liabilities, increase in operating liabilities. So it was minus 3,400, which was trade payables. It has increased. It has increased twice. It is now plus 2,800 unit or 280 crores. That means that trade payables, so they were paying earlier people in advance. Now they are not paying. There is increase in liability. That means they have still to pay.
But what could be causing this though?
Because
sitting and people are not paying as well.
Yeah,
so would they not be tightening their line of credit, because obviously if I have a lot of inventory sitting there, that is already a point of concern. If I'm still having a lot of receivables on top of that, then
No,
then
so if you have a plant, then you have
actually,
to run the plant at a particular operating point, right? If you purchase a land in Tamil Nadu at wherever the cars are made, whatever car SEZ, the government will give you the land and say you have to make suppose 10,000 units of tires a month. For that, you have hired 100 people, right? It's a part of the deal that you will hire local people. You cannot go
yes.
and start firing people, but you have to run that thing. So you cannot make 100 people make less tires. What you
Mm,
could do is that if the tires made in India are cheaper, you could
mm,
then go and sell those tires to South Africa, Brazil, other growing economies,
mm.
right? So instead of letting the inventory sit here, you can go
Mm.
and sell this inventory outside.
Right.
So why you did not do that? That means you hoped that because either the cost of shipping from India to those countries would be too high, and
Mm,
then you will keep the inventories here. Or what you will do, you hope that the market will improve, or the government will
mm,
make some changes.
mm,
In that case, you will keep the inventories. You will keep the trade receivables high. You will not call people as defaulters. Because if you go to a shopkeeper and tell that, hey, you have not paid me, you kept the asset, he'll say, yeah, please take your tires back. They are not selling.
exactly.
What
Yeah.
will I do? I will take the MRF they're giving me for free. So in this condition, you will see who is sitting on the largest pile of cash. Is
Mm,
MRF, JK, CAT or Apollo? Who has the largest pile of cash? And they can buy large um, warehouses or rent large warehouses, stock tires, and give larger credits to shopkeepers. And
mm,
they will say, so due to this, they have the other person who does not give, they have to give. Otherwise, the shopkeeper will say, please remove the tires because it's taking up my space,
exactly. Yeah.
right? And so that is something that you have to look from the business perspective. That's where
Mm,
now you see the money coming in from uh, when we talked about recast into operating versus non-operating and identify accounting red flags in class. So we are doing this. That we recast those formula into operating and non-operating. Then you can see where is cash flow from investing, cash flow from operating. So cash
mm,
flow from operating has to be the largest cash flow.
yes.
If the company is making most money from this one, so 960 crores come from operating. Let's see how much cash flow comes from investing.
Mm,
Net cash flow from operating is around 115 crores. Okay,
mm.
1152 crores, 115. I don't know why they have put rupees millions. I don't know. There is no such big change here. Yeah. See, loans to subsidiaries net of repayment. This is fourth from bottom. That they have given out loans to their own subsidiaries and they have made that as a negative cash flow here. Did you notice this?
Yes, I can see it now.
So this loan to subsidiaries net of repayment.
Mm,
That's 2,210 crores is a loan that they have given to their own subsidiary. And they have been very lucky. See, maturity of mutual funds. They have made 503 crores in mutual funds.
yes,
A
yes, yes.
tire company should not be investing in mutual funds.
Why?
In mutual funds is for retail customers, like for you and me. They should be
Mm,
buying long-term bonds.
I see. Because mutual funds are a little volatile, is what
Yeah.
you're saying.
What
Okay,
if they would
okay.
have lost money?
Correct.
So because they are not a investment bank, right? So their job is to sell tires, make tires, sell tires.
Mm,
Unless this is a, unless they have Apollo Finance. Okay, so
mm,
now comes another picture.
ah,
So for you to also do some research, some investigative work, look if they have an Apollo Finance. Make a note of it. Look later. So what they
ah,
do is that they will set up another finance subsidiary, and that
mm,
the job of that finance subsidiary is to give loans to people to buy Apollo tires.
mm.
So in that case, then they can invest in mutual funds and whatever through Apollo Finance.
Is it similar to TVS Sundaram Finance?
TVS Sundaram Finance? No. I'll give an example. So when I was about to buy Honda City, or I was confused between Toyota and Honda. So Toyota said that we have our own Toyota financing as well. So you can take a car loan from SBI, or you can take a loan from Toyota. If you take a loan from Toyota, it will be at lower interest, it will be like 5%. But if you take a loan from bank, it will be 10%. So take loan from us. Right? It's like Paytm giving loan to buy their own product. I don't know, it's not Paytm. It's like someone giving loans to buy their own products.
Makes sense.
So what they do is that they put their money back into their own business in the form of financing the sale of their own products. So what if, for example, Maruti doesn't give loan for you to buy Toyota car? Toyota will give you money to buy Toyota car. And then that's a separate department of Toyota Finance. They will add a loan. They will collect loan from you. Everything happens from it. So if Apollo has that, then this kind of maturity of investment in mutual fund that is possible. Then they could have made investment. But even then, if you see there's a big variation. It was minus 67 crore last year. It's plus 503 crore. This huge jump, minus 678 to 5,000 jump, is something I don't think any regular company would do. What they will do is that
is it something that was risky but then ultimately paid off?
Yeah, it is a red flag, right? So you see this our in-class objective. What I have said is we will do recast of operating versus non-operating and identify accounting red flags.
Yes.
Right.
Yes.
So if SBI starts playing poker and starts investment in poker games, then it's a big problem.
Yes.
Right. So if it's your money, my money, then what SBI can do? So SBI can invest in LIC, pension funds, roads, bridges, which will 100% give returns. LIC cannot take the money and make a Dream 11 team, right? That is, they cannot play poker with public's money.
True.
Right? So that is something, so the cash flow from investing activity is, let's see, net cash flow, not net, then comes the cash flow from financing activities. So I'll give you one example where investing activities cash flow is good. So cash flow investing activity is good when it is done to hedge the risk of raw material. So if you have purchased options, futures and derivatives of your raw material. For example, if your raw material is rubber and you feel that the price of rubber can go up. So then what you will do, you will sign a forward rate contract with the supplier of rubber to provide you rubber at particular price for next so many years. So that will be price is fixed. So if the price falls down, you will still pay that amount. If the price goes up, you will still pay that amount. So what it does, it ensures a particular level of profitability for you as a company. Right? So in that case, by making such financial instruments and trading in such financial instruments is absolutely meaningful.
True.
Right? But not in mutual funds. I don't think in mutual funds. And whatever we say in this chat is not advice for people to buy or sell equities. We are not certified financial advisors. We are just analyzing a balance sheet. These are all our individual opinions. So next is repayment of non-current borrowings. So it has come down. It's fine. Proceeds of current borrowings, including current maturity of non-current borrowings, is again one time. It's a one-time cash flow coming in here. Okay, one-time liability here. No big changes here from the financing activities. So cash and cash equivalents before the year, the beginning of year, and after the year, around 100 crore up and down. Here it was exactly the same, and this flow came because of a decrease in cash and cash equivalent, and this decrease happened because of all these one-time expenses, one-time costs being accrued by the company. So this is our analysis of. So what your task is?
Yes, yes.
Is to look at B10, B17, B18,
B16 as well.
B16 as well. Then also look at all these segments. Make your own hypothesis of why this could be the case, right? Um, and then make your version of the commentary on these numbers. The way I have made, just like the red and green and black and all these colors, you can copy this sheet into another one and then try to have a peer-to-peer comparison, and that will
Sure.
help you understand why two are different, right? So with this, let me show you what I have built. What I have built is something. So that concludes quite a bit of what I was intending to present. Now, what I will show you is a finance bootcamp dashboard that I've made. Right? This, if you have interest in making this and trying this out, feel free to do it. If you want to also use some other tool, you can do that as well. This is completely offline, runs on your computer. Window.
But I can't see your screen because it's still.
Yeah, I'm sharing. It's coming. Now you can see it, right? This is the finance bootcamp, and it's running locally on my computer. So here you can look for name of a company like Apollo Hospital, Apollo Tires, Apollo Finvest. So then Apollo Tires looks like this: the run price, PE ratio, ROC, market cap, profit, and sales growth, and whatever. This is for looking by company. You can also refresh this. It just loads all the companies it has in the database currently. You can do filter company by mega cap, large cap, mid cap, small cap, micro cap. You can filter the company. I have labeled them by session. So this is session 1, relevant one. Session 6 and 7 will cover this P ratio components. Session 4 and 5 will have this minimum ROC, profit growth, profitability filter, and analysis type. In analysis type, you can have comprehensive dashboard, valuation analysis, growth analysis, and quality screening. With this, if you click on generate analysis, what it will do, it will run some computation locally on your computer, and it will make some charts for you where you can play around and see what the data looks like. So it currently, with this, it analyzes 801 companies, and market cap 99% are profitable, this something stuff, and then you can see some analysis here. For example, if you see this company, this tiny company is WeWork India. It's trading at 33x P ratio and 137% ROC and the 151 profit growth. One of the rarest companies you will find which is giving more than 150% profit growth and 33x P ratio, right? You click on home, it again comes back, and then you can play around and see. Usually this is a sweet spot where it has high return on capital. That means the right should be very right as possible and down as possible. The vertical path is P ratio. Either um, if these circles are going up, that means they're very expensive compared to what they're earning, and if they're on the left side, then they're not efficient in terms of utilizing the capital. ROC versus PE chart. So the best company here is Riganto Enterprises, for example. Riganto Enterprises, I don't know what they do, but they have some. I don't know how they have 2500% profit growth. Maybe they are very small. That's the reason they have such a huge growth. But you will find such outliers very quickly, right? Next is market cap. So then you can see small cap, large cap, mid cap, small. I'll send this zip file to you so that you can run your own laptop. And micro cap and small cap and mid cap. Next is, this will cover in next session, which is tomorrow. So tomorrow, what we'll do is we'll look at the sales versus profit growth matrix. So we'll see companies which are on the right side here, which are growing fast, but are profitable enough as well. So you will see some companies like Ganesh Green, Basilic here, Chandewala Foods here, and then you will have Autocorp of Goa, you have Utsav. So you want people on the top right in this part. In this part are the companies which have very high sales and very high profit growth.
Okay.
So you would have Agarwal, Toffeen, Sativa, Satwa Engineering. So they are very high. What you can also do is that you can select different metrics here. So there's an option to advanced chart option. You can select mean, median, whatever you're doing. You can select bubble sizes, sales, or whatever, and it will update and it will show you whatever is relevant for these. Then there's something called as high quality investment opportunity. So this is auto selected companies which have ROC greater than 25%. Return on capital employed is more than 25%. PE ratio is less than 30, and profit growth is less than 15. So you have life insurance, Vedanta, Zinc, LTI, Hero MotoCorp, Vari, Lloyd, Suzlon, Premier, Aditya. You can see some very common names like Vari and Suzlon. Both are renewable energy. So the push of renewable energy helps in the growth of Vedanta, Vari, and Suzlon. As wind power, so Vedanta is wind power and solar power. Suzlon is only wind power. Vari is solar power, right? So that's the reason they are growing very fast. LIC again, post IPO, post growth, they will show some kind of um, high growth, and of course LIC is now allowed to invest the money of um, the money that they can diversify their investment portfolio into risky market equity linked investments can also be made by LIC now. Earlier it was only in stable securities and growth. Now they can take a bit more riskier investments on their asset base. Next is LTI. LTI is a very unique. I have studied LTI very closely, and they are they're a dark horse here. I'll tell you why. If you see, this is again old data. If you see what has happened for the last few days, the stocks of all the IT industries have collapsed. The stocks of all these IT industries have collapsed because people feel that AI is going to take away the $250 billion Indian IT industry, which is the Infosys, Wipro, Tech Mahindra, and all the big TCS and whatsoever. LTI is part of that bandwagon, so they are someone who can be impacted the most by AI, and they would have their margins being eroded and the contracts being terminated and the profitability falling. But regardless, they still, because of the small size, they still have very good return on capital employed. So they are very efficient and they are growing fast as well. So if you see this ROC in growth number, they are still very attractive players. What other players you will find very attractive is Persistent Systems. Persistent is a Pune-based system, Pune-based IT company, mid-cap IT company, but they have shown very robust growth in the past few examples. So you can play around this as well. For example, you are selecting all profitable companies. You can only select loss-making companies. We want to take an example, right? So you will not have very lot of loss-making companies. You have 801 companies when selected all. When you have selected loss-making, if I select generate analysis, we will hardly have 10 companies making losses. Let's see. We have 6 companies making losses, and still they are here. So say Varroc Engineer, they are making losses but still showing profit growth here. Profit is growing, but the costs are growing. That means EBITDA and loss both go hand in hand. And you would see mid-cap company 1 and 5 other in the micro-cap, very small companies. And you'll find their names here. See, Cochin Malabar, Union Quality Plastics, Digi Content. If you see what Digi Content does, you can go in Digi Content Limited. Digi Content is now Hindustan Times, I guess. They don't even have a website.
Oh.
So about us, no.
Isn't that a little sketchy?
Yeah. What does Digi Content do?
Any information on Screener, perhaps?
Screener is also very good.
No. I'm saying maybe if the website is down, maybe if there's any residual information over
Yeah, so it is trading. It is trading. The website is down, but it's trading.
Right.
digicontent.co.in doesn't open. The screener link itself doesn't open. And it's trading in market. Media entertainment and publication. Advertising in media agency. Digi Content. See this number, 36% ROC, highest other than Casio Drive, it is the highest, and it is loss making minus net profit quarter this. They are profitable 10 CR minus 7 CR, but still very high ROC. Loss making means that they are not paying taxes. If you make a loss, you don't have to pay tax.
Yes, yes, yes.
Quarterly profit variation is 30%, almost same. Sales is 50 crores more than this, but they are still making loss. How can your sale be larger and your profit be, and you can still be, this is net profit last quarter, no?
Mm-hmm.
How can this be possible?
Maybe they're making profit for the first 3 quarters and then doing something to offset the profits.
The price, the point is they are deviating from the main trend. If you see, then the PE ratio is 7.2, so they are very good. They're good buys. If you're out in the market to buy, then for 30 rupees you can buy one stock. Very good buy, because they will jump back. See, ROC is 36%. That means whatever capital they are employing, they are getting 36 rupees back. It's cool 36 rupees back. But the problem is something else. Problem is something that they have, that screener has mentioned here. Company is reporting repeated profit, it's not paying out dividend. So if you invest, you can sell the stock and make money. But people in 1970s and 60s used to buy IBM to hold, because the stock itself will appreciate. That's one. Second is also the dividends. Right? So this company's stock will appreciate, but it will not pay dividend. So you want a stock that stock price should go up, which is this price, but a dividend should also go up, na? They should give some money back to you apart from this. So if you buy here and you sell here, you make cool money. But during this, what if this wouldn't have happened? Then at least dividend you would have got some money every quarter. It's like getting interest on your savings account. So if you have 1 lakh rupees in your FD, you will get 5%. You will get 5,000 rupees per year, right? 5% per annum.
Yes.
So you get 5,000 rupees if you buy 1 lakh worth of stock. If this is where you invested, stock went up, went down. At the end of 1 year, the stock is still 1 lakh. You've got nothing, because the dividend is nothing.
But do people actually invest in stock expecting some dividend?
Of course. That is the core principle of finance. The dividend distribution theory, DDT. The entire price of stock is determined by dividend.
I see.
So if you have not studied Gordon's formula and others, we'll cover that. We'll revise that portion of finance in the coming classes. The entire concept of price of a stock is given by the dividend it pays. So a company, if a company makes 100 rupees, so the first thing that a company has to do is to decide how much to pay back and how much to retain. That is called retained earnings. I think you're on mute.
Just a second. I think somebody's at the door.
Yeah, we will wrap it up. We'll wrap it up.
No. I'm handling someone else to take care of this. Just a second.
Okay.
Hi, Mr. Singh. Am I visible and audible?
Yeah, you're visible and audible. I'll just take a minute and close before 1:30. We have already gone beyond 1:15. So the entire work of a company, and I don't think now I need to present this as well. So what I want to say is that the entire job of a company is to, when you make money, is to have some retained earnings and then give everything else to investors.
Okay.
That is retained earnings. So the price of a stock is determined by how much money the company is giving back to the people.
Okay.
If the company gives back more money, then the stock price rises.
Huh.
So if company doesn't give money back, then the stock falls. So see here the digi content, anyway, you can't see in live stream, people can see the dividend yield is 0.
Okay.
Yeah, the dividend yield is 0. So only those people who have invested and they are in for long term, they are holding, or they are only getting money from the capital gains from the stock price, not by the dividend payouts.
Right.
See, the high was 60 rupees, low was 24 rupees. You are only making by selling this stock up and down.
Okay.
But you're not making money by getting dividend from the stock. That is possible when company is taking all the money for dividend and reinvesting in the stock. You say that I will not give you dividend. Whatever profit I make, I'll reinvest in my own company. I'll buy new laptops, new equipment, will hire more people, will increase our capital expense, will increase our revenue, our capital expense and the current expense, both. But will not pay money. If you want to stay with us, stay with us. Otherwise, you can quit and sell and quit. So these kind of companies do not pay dividend. So we'll pay dividend only when we have become big enough, and we'll pay dividend when we want to. We'll not pay dividend every quarter. Right? So because why I'm telling this, because if you see America, in America people buy IBM because IBM every quarter pays dividend, and IBM has been paying dividend for past 100 years.
I see.
So people who are retired, they do not have any other income. They put food on the table by the dividend that comes. It's like the interest on fixed deposit. In America, the interest on fixed deposit will be 1 or 2%. The dividend is around 5 to 6%. So it's better to have stocks like IBM, GE used to be old stocks. So dividend is your bread and butter. You don't sell stocks. You just take the money in dividend. And when the dividend comes, you pay some tax on dividend as well. The company has to pay DDT, which is dividend distribution tax. And people who get dividend, they are paid either through income tax bracket what they are paying, or company deducts some taxes on their behalf and pays. So those dividend anyway they get taxed. So the actual value that you get is somewhere around 80% of the dividend, but you still, dividend is what you earn, is the yield. Yield of an equity. In the same way, you have a yield of a bond. So bond yield and equity is dividend, for bond it's yield. How much money you get. It's not just the price of equity going up, it's also the dividend. So long answer to the short question, yes, dividend is very important. Dividend is the basis of entire economy through which this thing works. So this is again, so if we come back to our topic for today, which was to analyze a company, which we did. We also did recasting of all the metrics into operating versus non-operating. We identified some accounting red flags, which looked like an accounting red flag. And so output is a one-page financial snapshot, which I'll let you make. You can use large language model, or you can use your own language to write something what you saw as a difference, and then you can validate with a large language model that this is the right way of thinking, and then make a succinct summary of what is your opinion. Just like I talked that India did have, I talked about GST revision and the reduction in GST from 18% to 5%, and impact of GST rehaul on the sale of small cars, small passenger vehicles. That means up till 15 lakh rupees worth of internal combustion cars. So impact of that is not just on the sale of car, but also on the 5 tires. There were times that companies didn't give one stepney in the car, they were just giving 4 wheels, because they cannot give 3 wheels. They have to give 4 wheels in a car. So what they'll do, they'll not give the stepney. Usually the car will put one stepney in the dicky, so that if the tire goes bust, you can replace it. So companies started penny pinching by giving a smaller tire, not having the alloy wheels there, the normal tire. What they'll do, they'll put four uh, tires which are like tubeless and one normal cheap tube tire as the stepney. All kind of things will happen. So as the car picks up, these will also pick up. So that is something that you can also make a commentary on what is going to happen on 31st of March. Not 31st of March, by 15th of April. By 31st of March, the year will end. By 15th of April, they'll start disclosing their annual performance. So you will see. So you can predict if the stock market prices of Apollo tires will go up from 15th April because of growth in the passenger vehicle segment. What you can also do is you can also look at the long-term partnerships and through which exclusive partnership with OEMs. And third is if the state government has made any MOUs. So if say Telangana state government, Tamil Nadu state government, Karnataka state government have made any exclusive arrangement or through tendering process, they have set out all those SRTCs. So you have KSRTC, Tamil Nadu State Road Transport Corporation, all these they have the buses. So all they, so whosoever has won, they would have, because buses will not buy, but the tires will change because they are very highly run buses. And all the tourism development corporation, they would have made out tenders or signed long-term MOUs. If those are in the news recently, then that's another big jump because that's a huge growth in tire business, institutional sales as well as B2B business sales.
Sure.
So finally, if who will this report be for? Because when you're writing a report or one-page financial snapshot, you're making this financial snapshot for companies who want to understand Apollo from the eyes of a financial analyst who understands the business and India market and is able to make a commentary on the past performance over the past 2-3 years, post-COVID, recovery, cost of raw materials, and the growth, right? And then you can position Apollo either as in the strategy as a differentiator. They will not be competing on price, so they are not a low-cost operator, but as a differentiator or as a focus player. So that is what the differentiator is. Is it like a focus on high quality, or whether it's focus on just a very niche area that they are operating? Third is you can also look at the management disclosure analysis about is if the CEO is telling that they are planning to move away from B2C, which is the passenger vehicles, to move towards only businesses and fleet operators. If they are changing the mix of sales of their tires, which is the changing their consumer base from people like you and me to companies and large garages and stores, then that would also be something that you can capture, or you can ask in ChatGPT to get you this insight and put this as an insight as the projection of how the market would look like.
Okay, Mr. Singh. And so this management disclosure is just the call transcript, right? The agent transcript, right?
Yeah. So these, call transcript every quarter that they do.
Yeah, yeah.
This happens 4 times in a year, and the 5th is the annual report. 6th is if you can scrape using any of the ChatGPT or Gemini or something to scrape the Google News or something to get any such commentary being made about a shifting of their focus away from, just like for example we saw that one of the competitors is not in cars, is more in two-wheelers and trucks. So they were able to save because when the cars slowed down, the people who buy two-wheelers, they come from tier 2 cities or very rarely in tier 1 cities that the sale of two-wheeler comes down. For example, they are school-going students, college-going students, middle-class working people, so that their sales do not change that much. Or if the urban sales falls, the rural sales picks up to ensure that they do not make losses. Second is most of these Suzuki, they have export arms, so they can export immediately. They will not hold inventory. But cars have to hold inventory because they're making cars specific to India, as per India specific emission norms, India specific engine norms, India specific length norms. So all these norms exist, and due to these norms, we are focusing more on areas where the cars and their uh, inventory pile up, right? So with that, I think I'm absolutely at the end of today's session. How did you like it? Did you like this one? How it went? And do you have a lot of homework to do today? And then tomorrow we are going to do working capital session 2.
Yeah, yeah. So I was wondering because firstly I'll have to compare it with the last year, both consolidated and
Chat GPT,
summary.
everything, right? Whatever you have to do Chat GPT. Do not do manual work, because anything that you're going to do currently will be replaced by Chat GPT the moment you join a company. Everyone uses large language models. So just make a note of it. Ask Chat GPT, do it. Don't do yourself.
Sure, Mr. Sir.
Okay.
And so you want me to compare peers and last year as well?
Yes.
And so the inference that I'll have to draw is
they just look at, say, who is giving them money. So their money is coming from who? Customers, you and me, individual buyers, bus
just
owners.
1 second. Singh, I'm so sorry. I'll have to sort something out. Just 1 second.
Sure.
Yeah. Yes, Mr. Singh. So sorry again. I had to attend to someone else.
No problem. So with this, what you have to do is, one is, who is giving them you Apollo Tires the money. That money is coming from retail people. So you have the entire segment of 38 something that you have given in that sheet. Just look at that, and if that is changing, so if people who buy from you, are they changing, or are you changing who you want to sell? Number one. Number two, the cost that you are coming from. So the cost is, one's raw material, that's fine. Second is all these activities like investing in mutual funds, and then writing up a company, writing off a company, investing in subsidiary, giving loans to subsidiary, trade receivables, inventory pile up. Just take a screenshot of that thing and put it up in large language model, and ask, why is inventory piling up? What happened? Can you look up something on Google News and tell me? It will go look up and tell you that the inventory is piling because of this. Ask, is the inventory of two-wheeler or like smaller scooter tires, or car tires, or truck tires? What kind of inventory is piling up? And then where is it piling up? Is it in their own warehouse, or the distributor's warehouse, or in the final retail shop warehouse? Number three, are they extending the line of credit? Are the retailers saying that take away your tire, we can't sell it, we don't want it, we are occupying our precious space? Just write this, it will tell that they told it to them, they mentioned it in one of their announcements. So they said, okay, we'll give you money, we don't pay us. That's the reason their receivables have gone up. But don't keep it on your factory, because our factory we do not have place to keep tires. So put it in a truck, take it to all the states. Every state you give to all the people. You keep it in your own home. You pile up all the unsold items instead of me keeping it in my factory.
Okay, Mr. Singh.
So all these are the nuances that you bring as an analyst, right? Which system will not have. That's where your voice comes into picture. Your perspective comes into picture. Your way of looking into things comes into picture. Then that mutual funds thing. You can say that, is this job of Apollo Tires to invest in mutual funds? Why would someone have done it? Doesn't make sense. Right? So explain. Those are the accounting red flags.
Sure, perfect.
Right? So let's see you tomorrow.
Yes, Mr. Singh.
And don't get logged out. I'll stop the stream, and then okay, the stream is stopped, and but the point is, don't get logged out tomorrow.
Logged out of the door.
Of course.
I'm gonna keep everything at the hall for now.
Yeah, because
Yeah, I had